Now, we have a caller on the line. We have Richard from Sydney who's got a good question for us this evening. G'day, Richard. What's your question first for the new year?
Yeah, Happy New Year to you, Tony, and Gemma. And poor Gemma, listen, you will never stop spending, even their 20s and even into their 30s. A half-brother in his 40s. But anyhow, look, the question, Tony, is, look, either IVV, I watch Jimmy Cramer, and he suggests his first 10,000 in an S&P 500, or the FANGs, you know, Facebook, Amazon, Apple, Nvidia, or and Google Maker. Look, what do you think? Just IVV or potentially those five? Because look, they're big gorillas, mate. I'm thinking 10, 20 years. They're just going to cream it unless there's legislation against them. Just thoughts on that. Thank you very much, panel. Bye.
Thanks very much, Richard. You know, it's a really great question there, and there's two parts to it, and there's two I immediately come to. I'll come to you, Gemma, in a second in terms of the asset selection there. But the first is actually how you make the trade, Richard. And so you're talking about buying IVV. For those who aren't familiar with it, IVV is an iShares product, an exchange-traded fund, which will mirror the returns on the S&P 500. Now, the S&P 500 is the 500 biggest listed companies in the United States share market, aggregated into an index, and what IVV does is it moves in concert with the S&P 500 in the States. It's US dollar denominated, which means you also get a bit of a currency kicker in Australia if you have a weaker Australian dollar. Now, you can buy IVV through any broker account in Australia, through the ASX, and the assets and the money are essentially domiciled in Australia. The flip side, and what Richard's talking about though, is an intriguing thing, and Gemma, this is something you were saying earlier is really growing, is investors choosing to invest directly in a share, be it a Facebook, an Amazon, an Nvidia, all of the companies that Richard's just sort of mentioning. You know, how would you actually do it? What's your view? Would you do the ETF, or would you probably go the direct name and in doing so actually have to invest overseas through a broker account?
I think you want to be very, very confident you understand the companies in question if you want to go direct into the individual stocks. And I say that because, interestingly enough, the caller, I think it was Richard, mentioned regulatory risk and legislative risk. I mean, these companies are getting so enormous now. There is genuine legislative risk, certainly with Amazon and certainly with Facebook. So some of the environments they're moving into and some of the things that they're choosing to do, they are attracting the attention of regulators in many, many markets, not just in the US, and that could substantially crimp their future profits and earnings. They are valued at quite extraordinary valuations at the moment. So if you buy the S&P 500, as you mentioned, you will get access to those stocks anyway, but they will be a small proportion of your portfolio. If you buy them directly, obviously they'll be a much larger proportion of your portfolio. You can, as I mentioned earlier, buy them via an Australian broker if you want to, but you're buying them in the US. So you don't have to go and find yourself a US-based broker. That's going to make life really hard for you. You've got to go through your W8 Ben forms and that stuff. That's just excruciating. So you can buy them here if you want to, and we have traders who sit at home in their pajamas and buy US-based stocks, and they will buy Facebook because that's what they want. But one would hope in that scenario that they believe that Facebook as an individual company will outperform its peers, assuming it has any peers, let's be honest, Facebook. That's right. But it's the best pick within its own sector, that is the sector that you want to be exposed to and so on, whereas the S&P gives you a much broader range of revenue sources and longer term growth sources than just those individual stocks. I think if you are just starting out, I would go the S&P 500. I think that diversification is very valuable, and the opportunity to buy it in Australia rather than worrying about taking the additional currency risk or worrying about all of those additional elements might be more appropriate. Excellent
points. The other thing I might mention there too, Richard, just in terms of your options, exchange-traded funds in Australia have evolved a little bit now, and there's in fact a couple of technology funds that you can invest in. Of course, by default, they're going to be invested in these sorts of businesses. Now, two of them are BetaShares product. One is the NASDAQ 100. It actually replicates, of course, the NASDAQ, which, of course, is the technology-oriented bourse or exchange in the United States. It'll have many of the FAANG stocks you're talking about inside that portfolio. and that's actually NDQ from a ticker standpoint from my recollection. The other one you can have a look at, which is a bit intriguing, just to something Gemma mentioned earlier, is Internet Security. The ticker is HACK. Again, a BetaShares product, but HACK basically invests solely in internet security and internet technology companies like that. And at various times, it's actually done very well. Think about any time that your computer's hit by a virus, and everyone else's. A lot of these stocks actually rally very, very nicely. The last one to just mention in terms of an ETF in Australia is TECH. Now, it's a Morningstar ETF. Have a look at what's under the bonnet there as well. But again, you can get that diversification that Gemma's talking about, which is not just investing in a single name, but also reducing what I think is the execution risk, which is changing money into US dollars, basically dealing in the US markets, doing it overnight. Again, through an Australian broker, yes, but on the flip side there, just a few hurdles to get through. I think about the ease of buying an exchange-traded fund in Australia. So hopefully that helps a little bit. The last thing to say, IVV, it's a pretty good way to play the S&P 500. For those who are sort of not so fussed on some of the technology names as well, there's a couple of high-yielding names in the ETF area at the moment that focus a little bit more on retirement income in the S&P 500. UMAX is one of them, and there's a couple of others. So plenty of options out there now to actually get that local, to get the exposure to international markets locally without some of the execution risks that we're talking about.